Whoa. If you checked your crypto portfolio on January 20th, you probably felt that gut punch. I mean, billions of dollars just poof, vanished. It was a massive, sudden sell off that seemed to come out of nowhere, and it caught a lot of people completely off guard. So, you gotta be asking, what on earth just happened, right? What was the trigger for this huge market panic? Well, the answer, it's probably not what you're thinking. This has way less to do with crypto tech itself and a whole lot more to do with, believe it or not, global politics. So yeah, let's get into it. Okay, so it all kicked off with this number that, at first glance, doesn't look like much, -3%. A 3% drop in the global crypto market cap. But here's the thing, when we're talking about a market worth trillions of dollars, even a small percentage like that is, well, it's a colossal amount of money. And yeah, that 3% dip dragged the whole market cap down to about 3.21 trillion. And this wasn't just Bitcoin or Ether getting hit. No, this was a bloodbath. We're talking 95 of the top 100 cryptos were in the red. But you know where the real pain was? The liquidations. We saw a jaw-dropping $525 million in leveraged longs just get wiped out. Poof, gone. And remember, these are basically bets made with borrowed money that the price would keep going up. So when the market took that nosedive, all those positions got force closed, which, you guessed it, just poured more gasoline on the fire. So what caused all this chaos? What was the spark? It wasn't some big hack or a DeFi protocol blowing up, nothing like that. The main driver was a geopolitical standoff. Yep, a fight brewing between the US and some of its biggest allies in Europe. And this quote from President Trump really cuts right to the chase. I mean, he's saying it plain as day. Greenland is imperative for national and world security. That kind of language, that hardline stance, it just shot a massive wave of uncertainty straight into the global markets. And here's how quickly a diplomatic spat turned into a huge economic threat. First, Trump puts the Greenland acquisition on the table. Then, key allies like Denmark say, no way. So the US hits back, threatening a 10% tariff on 8 NATO countries. And they added a kicker. If there's no deal, that tariff jumps to 25%. All of a sudden, those old fears of a massive trade war were back, and they were very, very real. Okay, so let's connect the dots here. How does a political fight over Greenland, an island way up in the North Atlantic, cause the crypto market to tank? Well, it all boils down to one simple concept in finance: risk-off sentiment. Look, whenever there's big, scary, unpredictable stuff happening, like a potential trade war, investors get spooked. It's human nature. They basically hit the eject button on anything they see as high risk and run for cover in assets they think are safer. That panicked mood, that rush for the exits, that's what we call risk-off. And this is exactly what that rotation looks like. During a risk-off event, money just flees from one category to another. It drains out of so-called risk-on assets, things like crypto and high-growth tech stocks, and it floods into traditional safe haven assets, like gold and government bonds. And you can see it happening in real time. Look at Bitcoin. It was cruising along near $97,500, and then, boom, a steep nosedive. It was struggling just to hang on to that $92,000 level as investors ran for the hills. Now, check this out. At the exact same time Bitcoin was plummeting, look at what gold was doing. The price just exploded, hitting a new record high over $4,700 an ounce. It's the perfect picture of that risk-off rotation, money pouring out of Bitcoin and straight into gold. But here's where it gets really interesting, because we've got two completely different stories playing out at the same time. On one hand, you've got all this short-term price action driven by fear. But on the other hand, the long-term story, the actual adoption of crypto, well, that's telling us something else entirely. No surprise here, right? With all this volatility, the crypto fear and greed index is now planted firmly in fear territory. The sentiment out there, especially for traders, is just, it's not good. It's pretty pessimistic. But while all that fear is swirling around on the surface, just look at what's happening underneath. The actual foundation of crypto is getting stronger every day. You've got a major mortgage lender, NewRez, getting ready to accept crypto. Stake and Shake is putting $10 million of Bitcoin on its books. Anchorage Digital is raising a massive $400 million. And get this, even while prices are dropping, the US spot Ether ETFs are seeing money come in day after day. It's a huge disconnect, right? Short-term price versus long-term adoption. So that's the million-dollar question, isn't it? What happens next?
Are we just in a temporary dip, a chance to buy before the next leg up? Or is this the beginning of a much bigger, much scarier correction?
Well, a lot of the technical analysts out there are looking at this and saying, hey, this isn't the end of the world. They're calling it a wave 4 correction. And what that basically means is that this is a normal, even healthy breather in the middle of a much bigger, multi-year bull run. It's just a choppy, sideways phase we have to get through before the next big move up. So if you're watching the charts, these are the numbers that matter. For Bitcoin, $90,000 is the magic number. That's the key support we need to hold. If we break below that, analysts are eyeing a potential bottom somewhere between 71 and 84,000. But if we can get a strong pushback above 104,000, well, that's the signal that the bulls are officially back in charge. And you can't just look at the price charts. The regulatory side of things is really heating up. I mean, we've got huge discussions happening around the Clarity Act, new rules for stablecoins are coming, we're getting a new Fed chair, and big state laws like California's are about to kick in. Any one of these could be a massive catalyst for the market, one way or the other. And that brings us back to the biggest question of all. Think about it. We have this brand new asset class built on the idea of decentralization, and it's getting thrown around by old school traditional geopolitics. So what is this? Is it just short-term noise that we'll forget about in a couple of months? Or is this a real test, a fundamental test of whether crypto is ready to grow up and become a truly stable, independent player in the global economy? That's not just a billion-dollar question, it's a trillion-dollar question.